Welcome back, everyone, to the S and Reza podcast. This is episode number 38. In this episode, I'm going to be going solo, but I'm going to be talking to you about investing into real estate and giving you guys a few options as to what real estate investment vehicles are out there in the marketplace. Before we do that, if you're enjoying this content and if you're following me, please be sure to subscribe to the podcast channel and be sure to like, share, and subscribe so that we can reach our goal of 500 subscriptions by the end of the year. So based in my real estate journey in the last decade or so, what I have noticed is that a lot of people want to invest into real estate, but they don't know how to, or they procrastinate. And the reason why they procrastinate is because they look at the risk and their risk tolerance may not be as high as they thought it would be. But I'm here to tell you that real estate is one of the safest investments that you can make, one of the highest return on investments that you can get. And you might be saying to yourself, well, here's another realtor trying to sell me on a real estate investment. And yes, it is a biased opinion. But even before I got my license, I can tell you that real estate investing was always in the back of my mind because I saw people getting wealth, building wealth through real estate. And so for me, it was an idea that I could invest into one day in the future as well. Once I got my license, I kind of got more educated on the different types of real estate investing. And so I want to share with you the different types of real estate investments that you can make so that ultimately you can build wealth for you and your family down the road. So the first type of real estate investment is a real estate investment that will cash flow on a monthly basis. This is where you can buy a duplex or a triplex or even a multiplex or a multifamily, and you can get monthly rent, which will be a supplementary income to your already income that you may have through your job or your business. This is a very interesting and a very lucrative investment idea because now you have more income in your bank account. And the more properties you have that cash flow, you can make a business out of it. Now, the thing with properties that cash flow, a lot of times you're not going to find them in the Greater Toronto area because property prices are so expensive over here. Whatever rent you accumulate will not cover all of your expenses, so you might be in a negative cash flow situation. So the best way to purchase these cash flowing properties is to actually venture outside of the GTA, maybe even outside of Ontario, where you can find these types of properties, maybe in the middle of a town or a city. Could be a place like Sudbury, North Bay, Timmins, Ontario, Kingston, Ontario, Windsor, Ontario, where you can buy a nice duplex or a multiplex and start getting monthly rent from there. Now, the thing with cash flowing properties is a lot of times because you're buying them outside of the core of the city, they may not appreciate as much as a property would appreciate, let's say, in the city of Toronto. But for some people, that's still okay because they really don't care about appreciation. They just want to make sure that their expenses are being covered by the rent and they're making more income on top of that. The second type of investment property is a property that will give you appreciation year over year. Now, properties that appreciate year over year are mostly going to be found in a city like Toronto, a city like maybe Ottawa, where there's a lot of population, there's a lot of people living in that city, and there's demand. And so over time, demand continues to go up for housing, and those housing prices do go up in value. The thing about buying a property in the city of Toronto or the Greater Toronto area is that you may be in a negative cash flow situation. So if you buy a property for, let's say, $1 million and your rent is $3,500 a month, that rent is not going to cover all of your expenses. In fact, you may be in a negative cash flow scenario where you may be paying out of pocket $1,000 a month. On the flip side, you're also going to be getting quite a bit of appreciation. So if you look back from the year 2000 up until now, property prices in the GTA have appreciated almost 7% year over year, which is a great return. Now, negative cash flow situation is a bit of a hindrance and scares people away. So what I would recommend in this scenario is that you don't necessarily have to buy a property in the city of Toronto where a town home may be $1 million. You can instead buy a property in, let's say, Hamilton, Kingston, in Barrie, where you can buy a property half the price of Toronto and still get almost the same rent. So what that does is your negative cash flow scenario goes down significantly. Your appreciation is still really strong in these cities, almost 6 to 7% year over year. And by the next 5 or 10 years, you've gained significant equity with that property. And if history serves right, every 10 years, property values do tend to double or at least go up by a significant margin. The third type of investment is a pre-construction investment, where you purchase a pre-construction condo or a pre-construction house. And what that allows you to do is get into the market slowly without having to get a mortgage right away. So let's say, for example, you don't have the 20% down payment to put down to buy an existing property right now. You can purchase a brand new project that may be ready in 3 to 5 years, and you can put down as little as 5% to 10% and pay that deposit in installments over time. What that allows you to do is get into the market, gives you some flexibility, and also when the time comes for closing, at that point in time, the property value may go up. And if it doesn't go up, at least you'll be in a better financial situation where your income may be higher and you may be able to close on the property at that time. So the biggest benefit for a pre-construction investment is, number one, you can pay your deposit in installments over time. And number two, you don't have to get a mortgage right away because the mortgage will only come at the time of closing. The fourth type of investment vehicle in real estate is investing into a real estate investment trust or a land development or construction finance. And this is more suited for people who, let's say, don't want to deal with the day-to-day management of being a landlord, but they still want to get some exposure to real estate. And so if you want to do that, and if you're more curious about that type of investment vehicle, you can invest into a company that does land development deals, that does construction financing, where you can pay as little as $5,000 and get returns possibly of upwards of the 10 to 20% annually, which is an estimate. But these returns are extremely well. And there's tons of companies out there that can offer this for you as an investment vehicle, where you can even take your RRSPs, RESPs, and use those funds to invest into these companies. Now, I'm not licensed to sell these investments, but I do have companies that I work with, which I can introduce you to. And if that's something that you're interested in, then you can definitely take a look at that and get real estate exposure without having to do the day-to-day management of a landlord. So those are the four types of investment vehicles that I recommend to my clients when they're thinking about investing into real estate. Now, the question is, which one do I choose? Do I choose one over the other? Do I choose all four? Well, it depends really on your risk appetite. My advice has always been to have a balanced portfolio. So, for example, you don't want to buy properties that will, for example, only have the appreciation factor. Because let's say if you have 3 or 4 properties that are only focused on appreciation and don't give you any cash flow, what ends up happening is if interest rates go up, which they did recently, then you're going to be in a really negative cash flow situation. And that means that you're going to have to pay out of your pocket for 3 or 4 properties or multiple properties, which would put you in a financial bind. But what you want to do is have maybe one property that focuses on appreciation, one property that has a cash flowing perspective to it, maybe one pre-construction property, and maybe even diversify and invest a little bit into the land development deals, the construction financing. So these are, at the end of the day, the idea is to diversify your funds and not put all your eggs in one basket. So to conclude, the idea is that even if you had just one asset or one real estate aside from your primary residence, it can change the course of your financial future. A lot of people have their primary residence and that's the only asset they have and they hold on to. But just having one extra asset or house can change your life. And I've seen that because an extra asset can increase in value. It can give you leverage. You can refinance it. You can take out the equity from that property that's gone up in value. And now you can use that equity to do several things. You can give that money to your kids for them to buy a property. You can help fund your kids' college or university education. Maybe you can use that money for home renovations. You can use that money to buy another property potentially, or you can even use that money, sell that property and use it to pay off your existing mortgage for your primary residence. So you have lots and lots of options available when you do have even just one extra asset. And at the end of the day, I mean, if you're living in Canada or plan to live here for the next decade or the next 2 decades, we all know that things are going to get more expensive. And as they get more expensive, it's going to be harder and harder to enter the real estate market. So if you have any kids right now, my suggestion is to purchase or invest into one asset or 2 assets so that they have a future, so that they can leverage that when they're older so that they don't have to rent. Now, if you don't have the money right now to buy an investment property or even buy a primary residence, then I always recommend to my clients, don't fret. It's not a big deal. All you have to do is create a game plan to help save that money in the interim. Because even if you have a goal of, let's say, to buy a house in 5 years or 10 years, at least you have a game plan ready. And my experience has always been, when you have a game plan ready and when you have a plan to save money on a monthly basis, then over time that money will accumulate. And over time, you'll start to see that you'll find different ways of saving money. And eventually at some point in time, you will come to a point where you'll have enough money to put a down payment into a home. So I hope you enjoyed that episode. If you have any other questions about where to invest, how to invest, and if you need more details about these 4 different investment opportunities that I presented to you, please reach out to myself personally. You can email me, DM me, or message me, and I will be happy to provide more information.